We're 2 hours into the trading day. It's time for Yahoo Finance's Market Minute. Stocks are lower to start the week after a downgrade of the U.S.'s credit rating by Moody's. Sanmina Corp is buying AMD's AI server assembly plants in a $3 billion deal. AMD originally got the plans in its acquisition of ZT Systems, but the chipmaker said it would offload the business to avoid competing with its own customers. Meantime, CoreWeave looking to borrow billions of dollars less than 2 months after its scaled-down public debut. The hyperscaler will offer $1.5 billion in senior notes due in 2030. The company is also in the process of entering a delayed draw term loan of up to $2.6 billion. Drug maker Regeneron is purchasing DNA testing company 23andMe for over $250 million. The deal includes, quote, substantially all assets, but excludes the telehealth platform, pharmacy fulfillment business, and lab and test ordering services under Lemonade Health. The deal is scheduled to close July 1st. That's your Yahoo Finance Market Minute.
Welcome to Wealth. I'm Allie Canal, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, Portfolio Checkup. We'll review the biggest risks investors should be keeping an eye on, and stocks are back above their pre-tariff levels. We'll talk to one expert who says now might be a good time to rebalance your portfolio. Plus, changes to your retirement plans. Why one financial giant wants to let private market investments into your 401k. We'll discuss the pros and cons. Stay tuned. But first, we take a look at some of the market action 90 minutes into the trading day. Stocks are falling after Moody's downgraded the U.S. credit rating late Friday. That's putting pressure on equities along with the bond market and the U.S. dollar. Joining us now to discuss is Ellen Hazen. She's a portfolio manager and chief market strategist at FL Putnam Investment Management. Ellen, thank you for being here. Now let's start with that credit downgrade. Spooky markets a little bit this morning, but if history is any indication, prior U.S. credit downgrades haven't led to structurally higher interest rates, recessions, or sustained equity market declines. So given that, how much weight should investors really place on this latest downgrade? Does it carry any meaningful signal for future market or economic direction?
I think you put your finger right on it, Allie. I think that the downgrade was the third downgrade of those agencies over the last decade plus, right? So we had S&P downgrade originally, then we had Fitch, and now we have Moody. So now it's all three of them have downgraded. But if you look at both the equity market and the fixed income market, they've hardly responded. Why is that? It's because the downgrade was based on information that is widely available. Everyone knows deficit is running at 6.5% to 7% of GDP. Everyone knows that debt to GDP is pretty high and unsustainable. Everybody knows that most of the budget is taken up by Medicare, Medicaid, interest expense, and Social Security, as well as defense. And that if we're going to do that, if we're going to fix the deficit, then we need to address those areas. And certainly the bill that was put forward over the weekend doesn't really give us a lot of confidence. So I think the rating agencies were catching up with what the market already knows. I think the more significant impact or dynamic going on today is that this is in the context of U.S. stocks underperforming international stocks for the last several months, right? And we have seen earnings estimates outside the U.S. go up, while earnings estimates inside the U.S. are going down. And we have seen that economic expectations in terms of GDP for this year and next year are going down here. So I do think there's a little bit more of a nail in the coffin in the sense that investors are looking at other options, and particularly international investors are looking at other options. So you may see flows out of the U.S. Because of these structural reasons, and the last downgrade might be the catalyst to get them to actually pull the trigger and move that money, but I don't think it's the cause of it per se. I think it's based on information that the market already knows.
So interesting. You laid out a few potential risks there, right? With the flow of money from the U.S. to international markets, earnings revisions. Is there an underestimated risk in your view at this point?
I think the single biggest underestimated risk is negative estimate revisions due to some combination of tariffs and changes in immigration, right? So if you think very simplistically, GDP is equal to labor force times productivity. And if we start deporting people in the context of a pretty tight labor market, then that can cause inflation to go up, and it can also cause GDP to go down. So if immigration policy materially changes, I think that's an underappreciated risk, because that will impact corporate earnings. Companies will have to pay more for workers, and that's going to hurt their margins, leading to negative earnings estimate revision. So I think that's the biggest underestimated risk. I think the tariffs were an underestimated risk, and then they were an overestimated risk when the market was acting as though the April 2nd announcement would be implemented literally, which it's clear now that it won't be implemented literally. So that's less of a risk. But I do think the labor market is the single most important element holding up the U.S. economy and the markets. And if the labor market weakens because of immigration or any other reason, then that's the biggest risk.
Yeah, we've been hearing that from quite a few strategists at this point. You also say that valuations remain a risk. And heading into 2025, stocks were already stretched. So how concerned should investors be when it comes to stretched valuations at this point in the cycle? And are there pockets of opportunities out there that are maybe attractive right now?
Great question. So we started this year after 2 back-to-back years of over 25% S&P returns, with S&P valuations 2 standard deviations above the 30-year median. That's pretty high. Of course, we had that big swoon in March and April, and it bottomed at just over the median, so about average valuations. But now we've recouped almost all of that, and so we're back up above 1 standard deviation more expensive. So that is a risk. However, as there's the famous quote that markets can stay irrational longer than you can stay solvent, valuations can remain high. Valuation alone is never a catalyst, or rarely a catalyst. Valuation alone just tells you the downside if there's a negative catalyst that causes valuations to decline. It tells you where they can go, but valuations alone are not likely to do that. But you do have international stocks trading at much cheaper valuations. They're not expensive relative to the U.S. And now that we've seen geopolitical uncertainty, tariff uncertainty, economic uncertainty, and deglobalization, you may very well see more money continue to flow out of the U.S. into international stocks.
All right, Ellen, some great insight there. Thanks so much. Appreciate your time.
Thank you.
Now time for some of today's trending tickers. We're watching Ryanair, Reddit, and Shake Shack. First up, Ryanair shares rising on full-year earnings and positive commentary heading into the busy summer travel season. Full-year profit was in line with estimates, while a decline in fares drove traffic growth of 9% from the prior year, resulting in more than 200 million passengers. The company says summer demand is strong, with peak fares trending modestly ahead of the prior year. Bernstein adding in a client note that Q1 fare outlook in the mid to high teens is far stronger than expected. The airline also approved a 750 million euro buyback. Next, Reddit falling as Wells Fargo downgrades the stock to equal weight from overweight. The firm citing recent user disruptions, which will likely be more permanent as Google more aggressively implements AI. The firm's price target was also cut to $115 a share from the prior $168. That implies only 1.5% upside from the stock's last close. Finally, Shake Shack downgraded to hold from buy at TD Cowen, the firm citing the stock's high valuation amid a challenged consumer spending backdrop. Shares are up more than 50% since the 52-week low seen in early April, so the firm says risk-reward is now balanced. The analyst also called out the tough competition in the burger space, along with Shake Shack's reliance on urban markets, which have been challenged so far this year. The price target is set to $105 a share, a 12% decline from Friday's close, I should say. You can scan the QR code below to track the best and worst performing stocks of this session with Yahoo Finance's trending tickers page. Well, a big week for housing data on deck as the issue of affordability continues to weigh on home buyers. Yahoo Finance's Josh Lipton is here with a closer look. So we've seen this very challenged home buying experience. What's the latest that you're watching?
Yes, so listen, rates we know have been an ongoing headwind for the housing market. The average rate on your standard 30-year fixed mortgage, 6.92%. That's according to Mortgage News Daily. So what does that mean for affordability? Well, middle-income home buyers making $75,000 could afford just 21% of the available listings nationwide in March, and that is compared with 49% in 2019, according to a recent report from Realtor.com and the National Association of Realtors. For households, by the way, earning $50,000 annually, they can afford only about 9% of home listings today. So when will affordability start to improve here? I asked analyst Lance Lambert, who emphasizes that affordability is very strained.
Unless, home prices were to fall meaningfully or mortgage rates were to come down 1.5 percentage points, affordability is going to be in this strained environment. And so right now in the market, that's created additional choppiness for builders right here. It's still constraining turnover in the resale market. There's not many transactions happening for existing home sales. And there's a lot of home buyers still on the sidelines.
So as we try and make sense now of where the housing market is right now and where it could be headed next, more important data is on the way this week. Got earnings are on tap. Toll Brothers reports second quarter earnings results on May 20th. Then we get some existing home sales. That's coming on May 22nd, and new home sales on May 23rd. So where can there be potential opportunities for investors in this sector? I checked in with Jay McCandless over at Wedbush for a small cap play. He likes Beazer Homes, which he argues is attractively valued and at the leading edge of more energy efficient homes. In the large cap space, Jay tells me that the luxury home buyer is still holding up relatively better. So he likes Toll Brothers, and he's also a fan of Pulte Group. Allie.
Always a lot going on in this sector, Josh. Thank you for tracking that all for us.
You got it.
Well, our market action is straight ahead. Stay tuned. You're watching Yahoo Finance. U.S. stocks are back to trading around pre-tariff levels, and according to my next guest, this could be a good time to evaluate whether you are invested at the right risk level. Joining me now on set is Kristen Bitterly, head of Citi Global Wealth at Work. And Kristen, the recent pullback was a bit of a shock to the system for many investors out there. What are some lessons that we can take from the latest drawdown?
So it's very interesting. I think when you look back on any market pullback, you're going to have the same type of investor psychology and the same type of heuristic biases. We have a massive aversion to losses. We want clarity in terms of what is the policy outlook, what's going to happen with tariffs. And so I think that, now that the market has rallied back, this is a great moment to actually ensure that, does my financial plan make sense? Does my asset allocation make sense? How did I feel over the past couple of weeks? Was I someone who was really ready to make a change? You don't want to make those changes in the spike of volatility or in a sell-off. You want to take a moment right now when volatility has come in substantially, when the market has recovered those losses, to say, am I positioned in the way that makes sense for my own risk budget, no one else's?
We've been hearing a lot of market buzzword these days, from diversification to rebalancing to hedging. What does this all mean for the average investor, and how could they utilize those strategies in their own portfolios?
Sure. I think on the major thing is to take a look at what is your time horizon, what are your goals in terms of your overall wealth. And so taking a big step back and saying, again, it's not your goals, it's my goals. How is it preservation of wealth? Is it growth of wealth? Is it actually seeing appreciation of these assets? And so when we look at these buzzwords, what do they mean? So hedging strategies. What do hedging strategies do for you? It's like insurance, but on your portfolio. So if you're someone who says, I want to be invested because this market could grind higher, I saw what happened, I don't want a market time, but I want to dial back the risk and have some downside protection, that's exactly what hedging strategies do for you. They add downside protection to your portfolio so you can confidently stay invested. The other things you mentioned, like diversification, you want uncorrelated assets. If you have certain assets in your portfolio that do well when other assets are doing poorly, you want that in terms of mitigating some of this downside risk.
And given the Moody's U.S. credit rating downgrade, how are you looking at fixed income opportunities, and should you reallocate given that downgrade?
So the downgrade, I think, is basically telling us what the market already was telling us in terms of some of the risks on the horizon. So I don't necessarily think that in and of itself is that significant, but I do think that combined with what we're looking in terms of the bill going through Congress as we speak, looking at some of the inflationary forces, how the U.S. is actually going to be able to finance this. So when we look at the spending bill and say net from a deficit standpoint, what does this mean for our overall budget deficit? And what is that going to do to fixed income assets, particularly when you're seeing the movement 10 years, 30 years? I think it's important to actually, you can have fixed income, but you want to lean into quality and you want to lean into shorter and intermediate duration as opposed to being exposed to some of that volatility longer end on the curve.
And let's talk about big tech, because we saw big tech lead a lot of the gains, but it also led a lot of the losses when we saw this latest drawdown. So how confident are you in the future trajectory of big tech? Do you think this sector can continue to be a leader here?
I think any company that has a very strong balance sheet and is able to withstand some of this volatility is going to be a leader. So what are we looking for? We're looking for strong companies with strong free cash flow generation that can actually, they can fund and finance their own growth. So looking at Q1 earnings, what were some of the benefits and some of the green shoots out of Q1 earnings was the fact that a lot of these companies came out and they said, we are going to continue CapEx. We have plans to not back down on a lot of these things. Are we prioritizing? Yes, but we're going to continue to spend. We're going to continue to invest. And so I think the idea that when you look at these companies with large balance sheets that are really well-managed balance sheets that continue to generate that free cash flow, there are some interesting opportunities there. And remember, tech does also provide a little bit of a defensive. If we think of like utilities, what are some of those things in a recessionary environment that you are not giving up? There is an element that you're gonna still have your smartphone, you are still gonna make sure you're connected to the internet, you are still gonna make sure that you are engaged in all of the devices that you need to be able to do your job, be able to go to school, et cetera.
Netflix has been a big tech story that's been cited as a defensive play. Shares are up over 30% at this point, but there's also been a recent focus on opportunities beyond the US. Are there certain regions, sectors that you think investors should be looking at internationally?
So international for us is something where it's definitely an active management and also something where it's idiosyncratic in nature. So you don't want to go into a market where you could actually be overexposed to value. You could be overexposed to certain sectors without knowing it. So sometimes just going in and buying the ETF or doing something that's index-based is not going to get you the exposure that you want. So I would say international diversification, it certainly has worked year to date. We can see a lot of those capital flows, particularly for international investors who are pulling money out of the US and going into markets like Asia and Europe. We've seen the benefit from that standpoint. But what I would say is, for US investors, diversifying internationally can make sense, but just make sure that you're in the sectors that you want exposure to that are some of those long-term secular growth trends instead of being exposed to parts of the market that don't make sense.
As we were talking about in the break, it's been a pretty wild time, but some great advice to sort of keep everyone level-headed during this time. Kristen, thank you so much. Appreciate it.
Thank you.
Coming up, a big 401k provider will add private market investments as an option later this year. Is that right for your portfolio? I discuss with the host of Decoding Retirement, Bob Powell. Stay tuned. Welcome back to Yahoo Finance. Let's get a quick check on the markets. We're seeing all three major indexes trading in the red. The NASDAQ leading the declines off about 0.5%, but we are well off the session lows that we saw earlier as investors continue to digest what this Moody's credit downgrade means for their portfolios. I do want to take a quick look, though, at long-term Treasury yields, particularly the 30-year yields. We are trading right around 5%. That's a key technical level. And year to date, we have seen long-term yields on a bit of a bumpy ride, largely driven by these trade tariff uncertainties, along with further uncertainties when it comes to the Fed, the inflation outlook. We are up around 7 basis points right now, year to date, up nearly 4%. The 10-year yield, that's trading around 4.5%. Not the highest that we've seen so far this year, but still trending and creeping back up. So yields, an important story to continue to watch. I also want to take a look at Bitcoin because we've seen a bit of a rally compared to what we've seen in the spring. We are currently trading at just around 104,000 a coin, a little bit above that at this point. Year to date, we are up around 11%. We saw this selling action happen in March and April, but as we continue to see what the Trump administration plans to do with Bitcoin, more crypto-friendly policies, that could be a near-term catalyst to come. And as a reminder, Coinbase is trading on the S&P 500 for the first time. We're seeing shares a bit under pressure today. Next up, financial services company Empower, which oversees $1.8 trillion in 401k type plans for 19 million people, is offering something new for your retirement accounts: private markets investments. The firm announcing assets like private credit and real estate will be available in some of the accounts it administers later this year. So what does this mean for the larger 401k landscape? And do you want alternative assets in your retirement account? Here to react is Bob Powell, editor and publisher of Retirement Daily and host of Yahoo Finance's Decoding Retirement video podcast. So Bob, this has been described as a big opportunity to get private investments into the hands of individual investors. So to start, can you break down what exactly we mean by private investments and how do they differ from more traditional public market options?
Yeah, so it's really simple, Allie. Think of private equity investing in companies that are not listed on the public stock exchanges like the New York Stock Exchange, or in the case of private credit, you as an investor are loaning money directly to a company as opposed to a bank loaning that company money. And there's a couple of reasons why this trend is going on, Allie, that it's worth mentioning. One is the number of publicly traded companies on the New York Stock Exchange, for instance, is declining, but the number of private companies is on the rise. And it's part of a larger trend that's been going on for decades in the financial services industry, which is we're looking at the democratization of investing. And so heretofore, individual investors were not able really to invest in private assets, private equity, private credit, private real estate. But over time, now we're seeing the democratization of these investments such that they're now being made available to average investors, whereas in the past they were only available to pension plans and endowment funds.
And it's interesting, Bob, because there are various types of thinking here. And let's start with the potential upside. What's the advantage of holding private assets within your 401k?
Sure, Allie. There's three things that you need to think about. One would be that there's a higher return potential. In the case of private equity, you might see returns in excess of, say, 16%, where the long-term average for publicly traded companies might be 10 to 12%. Investing in these investments also gives you the opportunity for greater diversification. These investments tend not to move in lockstep with publicly traded stocks or publicly traded bonds. And then, faster growth. There's the opportunity for your retirement account to grow that much faster, for you to accumulate that much larger of a nest egg for retirement. But there are downsides.
Well, let's talk about those downsides. Why is it a risk?
Well, these investments are complex and they tend to be illiquid. So unlike mutual funds or ETFs, where you have the ability to trade daily or on the minute or on the second, your investment is largely locked up. And oftentimes you can't access the money in a private equity or private credit fund or a private real estate fund only on the quarter, typically. And then there's the issue of higher fees. These have higher fees than your typical mutual fund or ETF. And there's less transparency. With a publicly traded company, you're getting reports that they have to submit to the SEC, 10Qs, 10Ks, et cetera. These private companies are not subject to the same disclosure rules that publicly traded companies have.
So given these risks and rewards, how should investors think about whether and how much to allocate to these alternative assets within a 401k or retirement portfolio?
Yeah, so I think the big question for me is always, what is the risk that you're taking in order to get the return? What's the risk-adjusted performance? So think carefully about that, and think carefully about how these investments fit in with your overall goals and whether the cost and the risks that are associated with it justify the investment. Now, if you're investing in a target date fund, it's likely that the percent allocated to these investments would be maybe minor, 5%. But in the case of Empower, they're going to be offered through what are called managed accounts. And there you may have the opportunity to invest from, say, 5 to upwards of, say, 20%. And so you just really need to understand what risk are you taking in order to get the return that you desire.
Bob, thank you so much for breaking that down. You can catch more of Bob Powell on new episodes of Decoding Retirement every Tuesday on Yahoo Finance. Coming up, is your wallet feeling a little light this spring from all those vacation plans? We're going to help you with some money-saving tips for the summer after the break.
40% of consumers say they're prioritizing spending on travel this year. That is up from 28% in 2024, according to a Bank of America survey. So, how can families work together to fit travel into their budget? Joining me now, back on set, we've got Mary Hines-Stroh, who is Bank of America's head of product for consumer business and wealth management, banking and lending. Great to see you again.
Great to see you.
So let's talk about this here a little bit, because consumer sentiment data shows many Americans are feeling uncertain about the U.S. economy going forward, but we all need some relief, some relaxation, some rest. Should they be prioritizing travel over saving right now?
Well, you want to be financially responsible. And having financial stress is not good. So you certainly need to have a cushion. We recommend between 3 months to a year of your monthly expenses in that cushion. But it doesn't mean you have to cut travel out altogether. You just need to do it in an affordable way.
So how can families fit travel into their budget? What are the first steps that they need to be taking?
Well, what's really helpful is to be flexible. Now, that's harder when you have kids because you're sometimes bound by their vacation. But look for things that you can do, that you can drive to instead of flying. Go off peak. Also, instead of renting hotel rooms, which can be really hard if you have a large family, you might need 2 or 3 rooms, rent a house. That enables you to cut costs on hotel, but also then you can eat in that house sometimes instead of going out.
Certainly. So what are the best ways to save up for a planned vacation, putting those expenses together and really knowing what the marker is that you need to hit?
Yeah, well, come up with what your budget is. Where do you want to go? I just got back from a ski trip with my family.
Congrats.
Thank you. I survived, is all I'll say. But that's expensive because you have the equipment, the lift tickets, the airfare. So really lay out what your costs are for that vacation and put a target date for it, and then allocate a certain amount of money with every paycheck to that account. Either create a separate travel account or use some automated tools that move money directly from your checking account into your savings account.
And what about couples? How can you work together to prepare for a trip?
Well, that can be hard because couples aren't always on the same page. And so that's start with, what are your priorities? Where do you want to go? Like with my family, my husband likes extra leg room. I don't care, I'm short. I'd rather have a nicer hotel. So figure out what means the most and come up with that plan. And remember, not everything has to cost money. If you go on a beach vacation, you just really need a bathing suit. Hikes are free. So have that balance of those special excursions that cost money with just doing things together.
Some key reminders there. So also, how can families find deals to maximize savings?
Well, there are a lot of apps out there that collect all of the deals, and you should really look at those to make sure you're getting the best price on whether airfare or hotel. Also, take advantage of all the loyalty programs for airfare, hotels, excursions, because then you can actually earn rewards to help pay. And then always use a rewards card when you're traveling or making those purchases so you can offset yours. Like the trip I just took to Utah, all of my flights were covered by my Bank of America rewards points.
Wow, all right. Sounds like you're layering some rewards out there and putting those all together to make the trip happen. Mary, thanks so much. Sounds like you guys had a great trip.
Earlier this year, many Americans were on the fence about whether or not to take that summer trip, but now there is a rising tide of travelers planning those summer vacations. Here to offer some words of wisdom about financially planning for your next vacay is Yahoo Finance senior columnist Carrie Hannon. And Carrie, I just came back from an early summer trip, so I wish we had this segment and chatted beforehand, but where are we seeing the demand for this travel right now?
Well, yeah, I mean, the thing is, people are planning to spend even more this summer than last, which is kind of a surprise based on what you just mentioned. But the folks at AAA told me sort of Memorial Day weekend is sort of the bellwether and shows what might be happening. And they expect airports to be absolutely packed over Memorial Day weekend, this coming weekend, to places like Orlando, New York City, Vegas. But what's really happening, Allie, is that falling prices. Airfares are at the lowest they've been in about 4 years, and gasoline is down. So this is making a whole set of possibilities for people. Now, road trips are particularly cool this year. For some reason, I can think of a few myself, but you have more control. And so that we're seeing a lot of domestic travel happening, people jumping in the car and planning for a road trip, and those gas prices certainly help there. For people going overseas, international trips, the big places seem to be Asia, Tokyo in particular. And of course, the big three, going to London, Paris, Rome, And Bangkok is kind of getting interesting again because of the White Lotus series. I think people are intrigued by it. So hotels are still pricey, but those are kind of the big trends.
I was going to say, it must be from the White Lotus when it comes to some of that Asia travel demand. So what are some financial travel tips from some of the pros that you've been speaking with?
Yeah, exactly. You know, some of the things are tried and true that we should always remember. But if you can be flexible, it's the key, right? If you can travel on midweek dates, you can drop airfares by 20%. So this is really something to consider. Look for, and also traveling early June, those first 2 weeks of June, or the end of August. Otherwise, peak summer is still going to be expensive. That's important to remember. So if you can shift, and if you can do, I mean, the fall season is actually quite good if you have that flexibility. Again, you know, plan for refundable fares because things happen, right? Now, we know that those are a little bit more expensive, but it does give you that flexibility if the world shifts on you and for whatever reason you need to cancel. I think it's also important for people to do these price monitors. So if you know where you're going and what dates you want to go, Hopper has one, Google Flights has one, Kayak, a lot of them, and it dings you when the prices go, the fare goes up or down, and it can sort of give you a framework of when you got to get going. Another big tip is truly, if you know where you want to go, don't procrastinate. As I said before, fares are incredibly low right now. So jump on it. I mean, look where you want to go. If it's international, maybe you have 2 weeks or something, but really, you know, get going. If you want to go somewhere, these fares are pretty sweet. I've been looking at them myself to go to Paris, and I'm like, I got to do it. Another thing is, we all know, we've heard all the headlines that recently about Newark Airport. Disruptions are part of the game in the airport world right now. So one travel expert I spoke to, who I respect, Haley Berg over at Hopper, she said, you know, trip insurance is something really people should consider this year because these things are happening and it's worth considering. I feel like I'm talking so fast, but one more thing to tell you, dupe. If you don't want, you can save by not going to that big flashy city like Barcelona and maybe picking something nearby. You get the culture vibe, but it's not as expensive. And another sort of important thing, Allie, to think about is that, you know, try to, if you're using credit cards, which all of us do when we travel, try to make sure you have one that does not charge foreign transaction fees. That can really surprise you at the end when you get home, and have them charge in the local currency. The final thing is follow the road rules. You need to have a real ID now in the U.S., so that real ID is important to have. Going overseas in UK, you need an electronic travel authorization now, and later this year throughout the EU, you're going to need travel authorization as well. So these are things that are shifting in the travel world. They'll just make your life a little bit smoother, and you can buckle up and go have some fun.
All right, some fantastic tips there. Be flexible, don't procrastinate. Carrie Hannon, thank you so much.
Thanks, Al.
Americans plan to spend a record-breaking $226.6 billion on vacations this summer. That's according to a new survey from Alliance Partners. That is up a little more than 2% compared to last year. But if you're looking to save money, our next guest says a staycation might be the right move for you. Here with more is George Kamal, co-host of The Ramsey Show and host of the George Kamal YouTube channel, as part of our saving series brought to you by Synchrony. George, summer spending tends to creep up on all of us. What are some ways that individuals and families can stay on budget without missing out on all the fun?
Well, it starts before summer. It starts with planning instead of just impulse and FOMO and going, we want to do all the things, just put it on credit cards and buy now, pay later, and we'll worry about it later. So the thing is, you got to sit down and make a plan for what's actually going to happen and then stick to that budget. And so the app that I use for that is called Every Dollar, to just make a plan before the month begins, and my wife and I align on what's happening this following month, and then we stick to that. And if we can't afford it, we just don't do it that month. It's called patience and delayed gratification.
And for those who tend to overspend during the summer months, and I'm mostly talking about myself here, what habits or strategies can help rein things in early, especially as we approach Memorial Day weekend? Many of us, it's the unofficial start of summer.
Well, a lot of it comes down to the marketing. That's when the marketing really ramps up and we see so many ads on our face. And as we scroll social media, and everything is so tempting because they make it seem like it's a once-in-a-lifetime deal. And so, again, you've got to budget ahead of time, make a plan for it, and know that all this marketing is coming your way, and go, nope, We said we're spending money over here, not over here. I don't care how much is going on sale. Never spend just to save. And if you do that with intentionality, you can actually enjoy the spending you do because it's not impulsive. There's no remorse or regret at the end of it, just intentionality.
In terms of how you're spending your money, how do you view credit cards versus cash? Are there certain advantages when it comes to savings?
Absolutely. You know, I know some of the previous guests have mentioned rewards cards. I don't have a single credit card to my name, and that has allowed me to keep guardrails on my spending because I physically can't spend money I don't have when I only use a debit card, and especially when I use cash. When you hand over some crisp dollar bills at the store, you feel pain. And what's happened over time is that spending has become frictionless. That's Apple Pay's tagline, cashless made effortless. They want it to be so easy to spend to where you don't even feel it anymore. And I think we need to add some friction back in so that we stop feeling so broke. And part of that is because of the frictionless spending. So create the guardrails, use a debit card, stick to a budget, and you'll feel so much better and less out of control.
And let's talk about groceries. That's been a big budget sucker these days. What's your advice when it comes to saving a little bit there?
Intentionality is what it comes down to, and this might mean meal planning ahead of time and deciding what I'm going to go into the grocery store to get. And I love the online grocery shopping now where you can add to cart and see the total before you walk in, before you see that end cap with your favorite snack on it and impulsively grab it before you check out. Just order it online and do the grocery pickup, especially if it's free and there's no added fees. That's a great way to do it. And then changing your grocery store. You know, I went to an Aldi the other day and I was shocked at how much I could get for that $100 bill that I handed over. So you got to change your grocery store, shop generic brand instead of name brand, and make some sacrifices and avoid the end caps and snack aisles. That's where people get into trouble.
I know I get into trouble in those aisles as well, George. Now, you do have a list of 7 baby steps when it comes to getting out of debt, building your wealth. Can you break down some of those for us?
Absolutely. Baby step 1 is a starter emergency fund of $1,000 because we found that 4 in 10 Americans have 0 in savings. And what that does, it causes them to go back into debt anytime there's an ankle bite or emergency. Once you have $1,000, move on to baby step 2. Pay off all of your consumer debt using the debt snowball method. That's smallest to largest balance, ignore the interest rates, try to get some momentum and roll that payment into the next one and into the next one. Once you're debt free, we're going to go back to that emergency fund in baby step 3 and get a fully funded emergency fund of 3 to 6 months of expenses. This is your never go into debt again insurance plan because you become the bank now. You don't need a lender to cover that emergency. And it's a great place to be. Debt free with an emergency fund, amazing financial foundation. Now we're ready to build for the future instead of paying for the past in baby step 4, where we invest 15% of our household income into retirement accounts that are tax advantaged. That's really going to set up people for wealth. And once you have your own mask on with retirement, you can help set up your kids for college in baby step 5, putting some money away into a 529 plan or an education savings account. And then focus on getting the mortgage paid off in baby step 6. Once you remove one of your largest fixed expenses, you can really begin to build wealth, spend more, upgrade your life the right way, and give more. And that leads to baby step 7, which is just continue to build wealth and give and leave a legacy. And that's really a wonderful place to be. It's a luxury for most Americans to even think about that. But that's the proven plan. It's the same one I followed to go from negative net worth to millionaire in 10 years.
Some small steps that can certainly go a long way. George Kamal, thank you so much for your time.
Thank you.
Coming up, budgeting for burnout. We have tips to help you prepare for a job transition. That's next on Wealth. This week on Wealth, we're helping you budget for burnout, walking you through the financial impact if you quit your job or are unexpectedly laid off. Joining me now is money-saving expert Andrea Warrock. Andrea, let's start with the basics here. If you're feeling burnt out at work, starting to think about stepping back, switching careers, even taking a break, how much should you have saved?
Well, ideally, in a perfect world, you should have approximately 6 months of living expenses saved in a separate account. Make sure it's out of sight, out of mind. But I know for a lot of Americans out there, having even $1,000 may seem overwhelming in your savings account. So I would start with smaller goals. Start with 1 month of living expenses. And to figure out how much that is, you need to list out all those reoccurring expenses that you have, those necessities, whether that's rent or mortgage or car payment, and all those kind of expenses. but you also want to think a little bit beyond the necessities. Are there any of those lifestyle expenses that you don't want to give up if you get laid off or you want to quit your job? Maybe this is a gym membership. You might need that for your mental health, or hair care services. You want to keep up your appearance for future job interviews. So you do need to build that into your estimated monthly expenses and create that savings goal.
What if you're laid off unexpectedly and you're not prepared? What should be your first move?
Okay, so if you're laid off and you're not prepared, you need to sit down and create a budget to make sure that you rid any wasteful spending out of your spending. Tame those impulse purchases by identifying the triggers. Or, negative emotions can fuel purchases that you really don't need. So you do need to find those alternative coping mechanisms. I like the zero-based budget method. This assigns a job to every dollar you have coming in. You have to speak with your HR employment to find out if you qualify for unemployment. Perhaps they're giving you some kind of package when you're being laid off, and prepare for how to stretch those dollars as far as possible. Also start hacking your monthly bills, call providers, and you want to negotiate rates, compare rates with competitors. There are a lot of things that you can do to lower those monthly expenses. And then of course, look for ways to supplement your income. Maybe there's a side hustle you could take on. This is like pet sitting or virtual tutoring. There are sites like taskrabbit.com or Handy where you could find odd jobs in your neighborhood just to keep up with some additional income coming in. And then, these are just some of the things that you could be doing to give yourself a little flexibility.
And if you are unemployed, how do you balance saving versus paying off maybe debt like student loans or your credit card bills?
Yeah. So when you are laid off, or even if you're planning for that emergency fund and you don't have enough cash set aside, you really do need to focus towards savings first. But at the same time, you don't want to let that interest pile up on any debt that you are carrying, like a high interest credit card, right? So what you would do is use a balance transfer card for credit card debt. Move the money from your current credit card that might have 20% interest or more to this new credit card, which will offer 0% for 12 to 21 months. This will buy you time to make just those minimum payments without that interest adding up. So you could put more towards savings, or, at least pay your bills without feeling stressed about that credit card bill. And then when it comes to student loans, call your lender. They should be able to give you some deferment because you are experiencing financial hardship. And if you own a home or own a car, find out if there's anything that you can do to defer those payments as well. I mean, that's not ideal ultimately, because the interest will still compound to your loan and you will owe that more down the road. But if you really can't make ends meet, those are options so that you don't, get into a worse financial position. And then when it comes to your savings account, I did want to mention that it's a really good move to open up a high yield savings account, because these accounts offer 4% or more in interest. So now your savings will earn a little money for you. That's like passive income you earn without having to do anything. And a great example is Bread Savings. They offer 4.3% annual percentage yield, only $100 required to open an account. That's compounded daily, deposited into your account at the end of the month. So just a no-brainer move to take advantage of that.
Andrea, some great advice there. Thank you so much for your time. Appreciate it.
Thanks for having me.
Let's do a final check of the markets here. We're still seeing all three major indexes trading in the red, again, well off of their session lows. We are seeing declines led by the NASDAQ, down about 0.5%. The Dow is down just around 1%, trading below the flat line, and the S&P 500 down roughly 0.3%. I do want to take a look at long-term yields, specifically the 30-year yield. We are seeing that trade just below 5. That is a critical number here. We are up about 6 basis points right now. Well, that's it for Wealth. I'm Alexandra Canal. Thank you so much for watching, and stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern.